All right, welcome to this explainer. We are diving straight into the underlying realities of the wildly anticipated SpaceX IPO. We're going to peel back the layers of the public narrative, dig right into the hard financial truths, and unpack some very recent, very quiet changes to market mechanics that could literally impact your own wallet. If you think this is just a story about rockets going to Mars, well, you're in for a real surprise.
So let's look at this number, $1.75 trillion. That is the targeted valuation being reported for this IPO. It's astronomical. That number would make this the largest initial public offering in human history. Just to put that into perspective for a second, at $1.75 trillion, SpaceX would be worth more than every single American defense contractor combined. We're talking more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks, literally all piled on top of each other.
But that massive valuation sets up a really fascinating contradiction. Because when you actually look at the financials, the consolidated company is bleeding cash. They are losing roughly $5 billion a year. So the $1.75 trillion question is this. Who exactly is lined up to purchase a company at the highest IPO valuation in history, while it's actively losing $5 billion a year? I mean, who is funding this?
Well, according to our source material, the answer is you. Yeah, you. Within a few weeks of this listing, your retirement account, your 401k, is poised to be one of the biggest buyers of SpaceX stock, whether you actively click buy or not. The analysis points out that thanks to some very specific, newly changed market mechanics, the passive index funds sitting in your retirement account are practically guaranteed to be the buyers here.
Section 1. 3 businesses in 1. Okay. To understand how a company losing $5 billion can somehow be valued at nearly $2 trillion, we really need to look under the hood. The revenue breakdown absolutely shatters public perception. I mean, if you ask 10 people on the street what SpaceX sells, they're going to say rockets, right? But the numbers show that last year, the rocket business brought in about $4 billion, which is huge, but it's only about 25% of their total revenue. The massive chunk, that's 61% right there, is their telecom side, Starlink. And then there's the rest, which heavily features their newly acquired AI arm, xAI.
Let's actually zero in on that AI piece first, because the source analysis pulls out some wild numbers here. SpaceX recently acquired xAI in an all-stock deal that valued xAI at $250 billion. But when we look at xAI objectively next to its peers, things get a little weird. OpenAI makes an estimated $24 billion in revenue at an $850 billion valuation. Anthropic makes over $30 billion and is valued around $400 billion. xAI? They're pulling in an estimated $1 billion in revenue, but they commanded a $250 billion price tag in this deal. The market is basically pricing it like this massive industry titan, but the actual revenue is telling a totally different story.
And it gets crazier when you look at what's actually happening inside xAI. The source highlights some pretty brutal internal realities. First off, they were burning through more than $1 billion a month. But even more shocking, by March of 2025, every single one of the 11 original heavyweight co-founders, we're talking top researchers from DeepMind, Google, OpenAI, they had all walked out. The CEO even admitted publicly that xAI needed to be rebuilt from scratch. So basically, SpaceX bought a $250 billion asset that is burning cash like crazy and needs a total reset.
But look, xAI is just one piece of the puzzle. Let's pivot over to the actual financial engine, the part investors are really drooling over, the crown jewel, Starlink. It's essentially this massive satellite internet provider. Since launching its beta back in 2020, Starlink has become the fastest scaling telecom company in history. They've got over 10 million active subscribers across 150 countries right now.
And this is exactly why it's the crown jewel. It isn't just about the $11.4 billion in revenue, it's about the crazy operational efficiency behind it. Just 2 years ago, Starlink's profit margins were at 41%. This year, they rocketed up to 63%. Adding over 20 points of margin expansion in 2 years is just staggering for a hardware-heavy telecom business. Make no mistake, this side of the company is an absolute cash-generating machine.
Which, of course, brings us right back to this negative $5 billion number. How does a company with this incredibly profitable telecom division and a booming rocket business end up so deeply in the red? Well, the source breaks it down. Even though Starlink and the rocket business made a combined $8 billion in profit last year, the sheer scale of the cash burn from xAI, again, roughly $1 billion a month, acted like an anchor. It dragged the entire consolidated company down to a $5 billion loss, despite bringing in $18.5 billion in total revenue. Section 2. The new NASDAQ rules.
Now, the real story behind this IPO isn't just about rockets or satellites. It's about systemic market mechanics. Under the old rules, if a company wanted to be in the prestigious NASDAQ 100 index, they had to wait 3 months. That gave the market time for proper price discovery before passive index funds were forced to buy in. You also needed a minimum free float, meaning at least 10% of the company's shares had to actually be available for public trading. But under the newly adopted fast entry rules, that 3-month seasoning period compressed down to just 15 days. And even crazier, that 10% minimum free float requirement was entirely scrapped. This is absolutely critical because SpaceX is reportedly targeting a free float of only 4 to 5%. 6 months ago, that would have instantly disqualified them. Today, it's a fast pass.
But the most fascinating technical shift here is what the source calls the hidden multiplier. Buried deep in these new rules is a mandate saying that if a company has a free float under 20%, NASDAQ now treats that float as if it's 3 times larger than it actually is. It's a total game changer. This legally forces index tracking ETFs to treat SpaceX's tiny 4-5% float as if it were 12 to 15%. By artificially inflating the mathematical weight of the stock in the index, the system effectively manufactures massive forced investment demand from passive funds.
Section 3. The exit liquidity trap. So how do all these highly technical hidden rules connect back to you? Well, let's look at the retail allocation. Normally, when a company goes public, they carve out maybe 5 to 10% of the offering for retail investors, everyday people. SpaceX, though, is targeting a massive 30% retail allocation. When explaining this super unusual move to bankers, the SpaceX CFO said it was because retail buyers have been so supportive of the company and of Elon, and they wanted to, quote, recognize that. Sounds generous, right?
Well, the source analysis translates that corporate PR into a pretty stark financial reality, and they highlight this incredibly blunt quote from portfolio manager George Noble. He said, "Your 401k is the exit liquidity." The core argument here is that the timeline of buyers and sellers is mismatched by design. Thanks to those new NASDAQ rules we just talked about, passive funds and retail retirement accounts are going to be automatically forced in early. They'll absorb the stock right at its peak $1.75 trillion valuation, which then allows the early insiders who are sitting on super low-cost shares to cash out comfortably.
And this whole situation really highlights the ultimate dilemma of passive investing. For years, passive index funds have been sold to us as the smart, safe way to invest. Low fees, instant diversification, a totally set-it-and-forget-it system. And yeah, that's all true. But the very mechanism that makes it so convenient, the automatic, hands-off purchasing, means you have absolutely zero vote and zero choice. When a company uses new fast entry rules and hidden multipliers to squeeze its way into an index, your retirement account just becomes a blind, guaranteed buyer. It automatically absorbs whatever peak valuation the market dictates. So, based on all this evidence, we really have to ask ourselves a pretty vital question here. Is the hands-off convenience of passive investing actually worth the hidden cost of becoming the guaranteed automatic buyer for a $1.75 trillion valuation you never even chose to invest in? It's a deeply complex system, and understanding these mechanics is really the only way to know what's happening inside your own portfolio. Thanks for joining me for this explainer, and definitely keep questioning the mechanics behind the headlines.